Hello, everybody. Welcome back to Fierrrce Forex for Beginners, Part 2, Module 2. So just before I say anything, guys, let me make a disclaimer. I'm not a financial advisor. I am not a financial consultant. Anything that I'm going to teach in this Forex for Beginners training is all based on my bias, personal experience, and is not set in stone. So what I'd suggest is it's always prudent for you as the student or somebody going through this content to just do your own research, because the Forex market is a risky market. It's one of the most volatile markets in the world. And so that being said, let's hit it. Yeah, guys, so we are back with part 2 or module 2 of our Fierrrce Forex for Beginners class. And today we are going to go into now definitions of the Forex market, terminologies, and so on and so forth. So without further ado, let's get right into it. As you all know, my name is Lilian Okado, Miss Fierrrce. So yes, so this is what we're going through today. Forex market definitions, quotations, and terminologies, right? If you liked part 1 or module 1 that I did earlier, please let me know. Would love to know, get some feedback so that I can keep improving the training as we go along. So today, again, this is for beginners and continuing from where we left off on the previous video, and we are just going to discuss what Forex is. I remember the first time I learned about Forex, I wasn't really sure what it was. It sounded like this very foreign, difficult thing that, of course, dealt with finances and so was really out of my league. But then when we think about it in a very basic sense, right? Foreign exchange, or Forex in short, happens every single day. Okay, so first of all, we know that it's the largest financial market in the world. Secondly, we know that there's a lot of exchange and trading that happens. And this exchange, okay, whether we participate in it or not, it's happening. The Forex market is a over $6 trillion industry. Okay, it's 7 times larger than the stock market. So every single day somewhere in the world, foreign exchange Forex is happening, or trading in one currency or another is happening. If you were to, let's say, take a flight from Nairobi city here in Kenya and you wanted to go to New York, you'd need dollars, right? So you'd need to change your Kenyan shilling into dollars. And if you're coming from the US, coming back into the country in Kenya, you'd have to change back your US dollar into Kenyan shilling. Now, imagine the number of flights that happen every single day. Now, think about it even in terms of trade across borders. If I was to purchase goods and services from China, I would need to translate or exchange my Kenyan shilling or my USD into Chinese yuan, or if they accept yuan, I'd have to change my local currency if they accept dollar, I'd have to change my local currency into USD. So global transactions have to happen within this foreign exchange market. You go to a bureau, that's where it happens. You go to the bank and you can change your dollars there or your local currency there into international currency. So that exchange, and if you can see here right now, I'm looking at the Kenyan shilling, and currently, as of 24th of Jan, this is the rate of the Kenyan shilling, of the USD against the Kenyan shilling, meaning that for you to get $1, one United States dollar equals 113.55 Kenyan shillings. What that means is that the US dollar is stronger than the Kenyan shilling. I don't know if you guys remember, there was a long time ago when the US dollar was 20 shillings. Okay, that was years ago in the 80s. And right now we are at 113.55. Okay, so we can see that back then it was cheaper to acquire dollars. Right now it's more expensive. So if you're traveling, you're going to spend a bit more of the Kenyan shilling. Okay, so hopefully that makes sense. Now, then when we talk about currency pairs, okay, it's important to know, as you've seen in the previous example, and even in these examples here, we are seeing 2 pairs, okay? So anytime we're talking about Forex, because we're talking about an exchange of one currency pair for another, okay, we are always quoting one currency against another. So we have 2 different types of currencies, and they are the base currency and the quote currency. So in these examples, you can see the first currency is the base currency, the second currency is the quote currency. So whether we are talking about USD Kenya shilling or USD JPY, Euro USD, that's basically how they are quoted. The base currency comes before the quote currency. Now, all these currencies, there are many of them, okay, obviously because we have so many countries in the world, okay, so anytime we're exchanging, you will see that all these currencies, yeah, are quoted by the International Organization for Standardization currency code. So if you want to find out any currency code for any country out there, just go to this website and you'll be able to find the same. So the base currency is the first currency pair, and the currency, and then the quote currency is the second one. Yeah. That being said, we also want to look at it from a quote perspective in the sense of the value. So sometimes you can go to a forex bureau, right, and or a bank teller, and you're asking for, let's say, for example, AUD. Maybe you're traveling to Australia and you want to know the rate of the AUD against the USD, and you'll be quoted for 0.76. What does that mean? So the AUD is the base currency, and the quote currency in this case is the second currency, which is the USD. So what this 0.76 means typically is that the AUD, like one Australian dollar, can be exchanged for 0.76 US dollars. That means that technically, okay, the US dollar is stronger than the AUD USD. So you'll take more AUD, you'll spend more AUD USD to purchase $1. Okay, so hopefully that makes sense. So usually the quote is based on the base currency. So this quote figure here, 0.76, when you go to a foreign exchange bureau, you see that table or that ticker or that order book on the screen with numbers flickering up, down, buy, sell, buy, sell. Those numbers are the numbers that are being quoted, and usually you're quoting the first pair against the second pair. Okay. So that being said, we are looking at now, we also have something called major currencies. And these are the major currencies. The USD, we know that these are the currencies of the major economies around the world. And this is the American economy, so USD, the Euro bloc, which is the Euro, the Japan, so the Japanese yen, UK, British pound, Canada, Canadian dollar, and Swiss franc. Okay, these are the major currencies. Okay, now these major currencies, there are about 28 combination of pairs of these major currencies. There's also one missing here, which is the AUD, the Australian dollar. So that's part of the major currencies. So when you combine these major currencies, okay, you can come up with a combination of 28 currency pairs. Okay, remember, when we are talking about Forex, we are talking about currency pairs, not just the currencies, because the currencies are always quoted in pairs. Okay, that's what we mean by currency pairs. So those are the major currencies. Then, of course, the major currency pairs are based off the major currencies. So, for example, when you look at GBP USD, I'm sure anytime you've listened to Bloomberg or any news, CNN business news, you probably hear some of the commentary, referring to cable, loonie, Aussie, Swissy, yen, euro, okay, Kiwi. Now, these are the major currency pairs. Okay, so based on the major currencies of the global economies or the major global economies. Okay, then we have, now these currencies are actually the most widely traded pairs. And so that makes them very, very liquid. Liquid meaning that it's very easy to cash them out. Like it's easy to purchase GBP USD because there's always market for it. There's always a market for GBP USD, USD card, and so on, because these are the major currencies. So most of the time, even if you travel, you'll be able to acquire these currencies very, very easy. Okay, so they're very, very, very liquid, hence very popular. Okay. And then we have, so sometimes people will ask, okay, so how do you know how to quote them, especially in the beginning? Later on, I think by the end of this training series, this will be common sense. But in the beginning, you must be wondering, okay, how do you quote them? Now, usually, if you look at this example here, this list here, this is a list of the major pairs, and we see the euro is listed first. So what this basically means is that any time you see the euro in a pair, it's definitely going to be the quoted first. It's going to be the first quote currency, and then whatever else is quoted next to it will be the base currency. So if you're talking about Euro USD, for example, you're talking about Euro CAD, Euro JPY, Euro, any pair, Euro always comes first. That has Euro, Euro always comes first. Okay, so if we had Euro and the yen together, it would be Euro JPY. If you had Euro and the Swiss franc, it would be Euro CHF. Okay, now when you look at the pound sterling, it's the second. So let's say, for example, we had the pound sterling and the Japanese yen. It's automatic. Pound sterling comes first and then yen. So it should be GBP JPY, GBP AUD. But if it's Euro GBP. Okay, so hopefully that makes sense. And the rest follows. So it'd be GBP New Zealand dollar, GBP NZD, GBP USD, GBP CAD, and so on and so forth. Then we have the Australian dollar coming after that. And this now, if you're talking about AUD, AUD always comes before the NZD. So it's AUD NZD, AUD USD, AUD CAD, AUD Swiss franc, AUD yen. If you're talking about New Zealand dollar, this comes before the USD. So NZD USD, NZD CAD, NZD CHF, NZD Japanese yen. So this list initially just helps you to have an idea of how to quote these major currencies. Okay, so hopefully this makes sense. But don't worry about this. This is just very basic information. And in time, this is going to become automatically, trust me. Okay. Then we have the cross pairs. Now, the cross pairs are the pairs that do not include the USD. So any pair out there that you hear, somebody names like Euro JPY, GBP JPY, NZD CAD, NZD CHF. Now, those are crosses. So again, when you listen to business news, sometimes you hear them talking about the cross pairs. They talk about the majors. So that's how you know what pairs are being discussed. Crosses have no USD in them. Majors are based on the major currencies. Yeah. Then we have the third category of pairs, which is the exotics. Okay, and these are the pairs that are outside of the major currencies and the exotics. That's pretty obvious. So we have pairs like the South African rand, the Turkish lira, the Mexican peso, the Singapore dollar, and sometimes you even see the Euro Mexican peso, Euro SGD, and so on and so forth. Okay, now these exotic pairs tend to be very illiquid. Now, when you say illiquid, basically, unlike the major currencies which are very liquid, these are possibly not very widely traded across the board. You'll find that maybe in the major economies, they are traded more in those markets. So you find that maybe the South African market tends to trade these pairs more within the global exchange. There are some people who like to trade exotics because of how they move. They're very, very, very volatile, but at the same time, they're very unpredictable. So especially for newbie traders, I wouldn't recommend you to just dive right into exotics. One, they have high spreads and very high commissions on the table off the bat. So you don't really want to go there, and especially if you're starting out with a small account. Which then brings me to the point that you will then need a bigger account to trade these currencies because the spreads are really huge. So you could find that you've entered a trade, and within a second of entering that trade, you already pulled back several hundred pips, so you'd be in a huge drawdown. And if you don't have the capital to cover that drawdown, then you find yourself in an unnecessary loss, and it can be very, very risky. Something else about exotics is that they're not usually listed in the economic calendar. So sometimes it's very hard to know what's happening with that pair, what major news is coming out of that economy. You have to do your extended research. The beautiful thing with these other major currencies is that we have like the Forex Factory. .com, which is a website that collects all major news items happening across the different currency pairs and the economies. We have other news sites like MyFX Daily, FX Street, and so on and so forth. But when you find exotic pairs, you really need to maybe dive deeper in terms of your research to actually just find out what's really happening across these exotics so that you're not caught on the wrong side of the market. However, they are very, very lucrative as well. But I usually don't like to say, don't trade them if you're just starting out. Focus on the major currencies first and then move on to the exotics. Now, we also have, so there's also, now just so you guys understand how this whole market is, We have, and hold on, just before I go into this, part of the currency, so the Forex market, in the Forex market, you trade the currencies, right? But you also have metals and commodities. So we have you can trade metals like gold and silver, platinum in the market as well. You can also trade commodities like oil, okay, in the market as well. You can trade, yeah, you can also trade indices like Dow Jones Average, Nasdaq, SP 500, and so on and so forth. Okay, so yes, we are talking about the foreign exchange market, but doesn't mean that you're just tied to trading currency pairs. You can also venture into commodities and so on. Now, the way this market is made up, it's an over-the-counter market. So what that means is that pairs are traded over the counter, literally, like there's no central exchange. So let's say, for example, I go to a Forex bureau. The rate I get at a Forex bureau can actually be very different from the rate I get at the bank, which is very different from the rate I get actually from the global exchange online. Even if, let's say, you Google the rate of these currencies online, you again may find a difference there because there is no central exchange. There's no one person who's controlling the market, unlike the stock market. In the stock market, if you were to buy shares or stocks, the prices are listed globally, okay, and they're the same for everybody around the world. Like you can't, it's a central exchange. You can't buy Apple more expensive with a different broker and so on and so forth and in a different country. No, unless maybe just in terms of transaction fees. But with Forex, it's different. It depends on which broker you're using to trade in. So it's an over-the-counter market, which means prices will vary across the country, which also then means that when you're trading and depending on the brokers that you'll be using to trade, different brokers will also have different pricing. So we could be taking a similar trade in the market, and based on the execution pricing that you're getting with the brokers, you may find that our entry into the market may be at different prices. So it's good to note that, okay? So that you don't get confused when you see different pricing. Now, we also have something called the interbank market. And the interbank market is just basically where the major banks exchange their currency. So we have the OTC market, which is where everybody else, the retail market, is thrown in. And then we have the interbank market. Now, why is there an interbank market? There's an interbank market because the interbanks, the huge banks, they really need their own platform to trade because they are moving billions, okay, in the market. So this interbank market is still within the foreign exchange market, but it's just separate from the retail market. Okay, so we have the interbank market, but we also have the retail market. So with the interbank market, these are the major banks that are in that market. So I'm sure you've heard of these banks, the Deutsche Bank, for example, HSBC, Citigroup, RBS, Goldman Sachs, Bank of America, JP Morgan, Credit Suisse, Morgan Stanley. Now these guys have their own order books, and they transact through, let's say, Thomson Reuters or electronic broking services, which are just the two main electronic brokering platforms at this level for the interbanks. Okay, understand that because they are moving billions, multiple billions, they cannot trade on the same. They will not find the liquidity to trade in the same OTC markets that the rest of us are trading in. Okay, now the interbank market actually accounts for 60 to 70% of all the volume of transactions in the entire global foreign exchange market. So what that means is, and this is where I think you should pay attention, when we are coming in as retail traders, so who are retail traders? Me and you who's trying to learn how to trade Forex, you as the individual who's going to be trading over your phone or on your laptop, you're part of the retail market. Now, we in the retail market make up only 3% of the entire global exchange. And then we have the interbank market who makes 60 to 70%. And then there's another percentage of people in the market who are now the huge banks, the dealers, other banks, hedge funds, etc. Like even if you think about it, local banks in your country, those make the other large participants. And then we also have the Forex brokers and retail brokers who take care of us retail traders. So these are the players in the entire market. Okay, but the interbanks are the biggest players, and then the banks, and then the rest of us. Okay. So we have certain terminologies that we use when we are talking about trading. Okay, and you'll hear this a lot. So we have these terminologies like buy order, which is basically, again, think of it in the very layman perspective. When you're buying anything, especially in terms of investment. For example, if you want to buy land, you'll always want to buy land or a house. You want to buy it at the best price. You want to buy it before it appreciates in value. So usually buy orders are when you're anticipating that the price of a currency pair is actually going to go up. So you place a buy order so that you buy it before it goes up and you make your money on the way up. A sell order is the reverse. So you're anticipating that the price of that currency has peaked and it's just about to start tapering out or going down. So you want to place a sell order, okay, just before it starts to drop so that you can be making your money on the way down. Now, some people will ask, how do I sell what I don't have? Buying, I can understand, but selling, I'll explain that shortly. Now, we also have spot price, something called spot price, which is basically the price of the currency as provided by the brokers, the banks. So whatever price you're getting, wherever you're purchasing currency pairs, whether it's at the brokers, whether it's on online trading platform, which I'll introduce you to shortly, that is the spot price. Okay, that is what your broker, your bank is giving you. That is the spot price. Then we have the order book, which usually shows a list of all buy and sell orders in the market. Now, order books are there. When you go to the bank, again, there's this screen showing prices going up and down, up and down, up and down of different currency pairs, right? That is the order book. And it's always running throughout the day when the market is open and different sessions are open. Then we have the bid price, and this is the price that you can sell a currency pair at, okay? And the ask price is the price you can buy at this particular point in time. So again, you'll see that in the order book. You'll see ask and bid column. Okay, so ask price is the price you can buy a currency pair at. Bid price is the price you can sell at. Okay, then we have the spread, and the spread is the difference between the bid and the ask price. Okay, so usually the spread is how brokers who provide you with these prices, execution prices in the market, that's how they usually make their money. So that's where the varied pricing comes in, whereby you find different vendors or platforms will give you different pricing because they price in their spreads and their commissions in there. So that's the spread difference between the ask and the bid price. Now, so this is how an order book looks like, okay? And we can see, we said buy is, there's the bid and the ask, buy and sell. So we can see the different, 21, 22, 19, 21, imagine this is the electronic screen where you're seeing the numbers moving. So you'd be seeing these numbers actually in motion. And it just basically means that there are people placing orders for AUD, USD at 21. Okay, they're quoting at 21 or at 22. Selling, basically people want to sell at these different prices. So there are literally multiple traders in the market who are willing to buy at either 21.19 or 18.5, or are willing to sell at 22.21.99. Okay, for example. Now the difference between the bid and the ask is the spread. So you can see the 21 to 22 difference is 1. Okay, that is the spread. Whatever that difference is the spread. Okay. Now we have something called pips, something else that you will use a lot when you're actually trying to calculate your price, change in price, okay, of a currency pair. So we have the point, the pip, the pipette. This is how I'm just listing it out. The point is basically, you can be used interchangeably, but it's the minimum change in price. So for example, if the Kenya shilling, the USD against the Kenya shilling is 113.25, and the price goes up to 113.35, or let's say 35, that would be about 10 points. It's gone up by 10 points, okay? or it's risen by, whatever amount of points, that minimum change in price from 20.25 to 0.35 is the point. Okay. Then we have what we also refer to as the pip. Okay. Now, when you look at the digits, especially when you're trading currency pairs that are on the major currencies, like I'm not sure you'd be able to trade unless you're using a local broker here in Kenya, but I don't think you'd be able to trade the USD Kenya shilling, for example, on some of these international brokers. You'll not be able to find them. But in this, so we're talking about major currencies, for example, and the exotics, what we just talked about. So we have the pip here, okay? And this is how, let's say, the currencies look like on a very simple term. So you find that there's a digit and then a decimal point, and then after the decimal point, there are numbers. Now, in this scenario, this is an example of one of the ways it can look. In this scenario, there are 4 digits, 1, 2, 3, 4, after the decimal point. Now, the last digit here, okay, is the pip. Now, you'll find that in some cases, we have an extra digit, which is the 5th digit. Okay. Now, this 5th digit is what is called the pipette. So the pip is the 4th digit. The pipette is the 5th digit. Okay. And then points is just the minimum change in price. So whatever number of points, when you subtract pricing, that's the point. But this last digit here is the pip, this is the pipette. Now, depending on what you're trading, whether you're trading currencies, metals, or indices, you'll find that with currencies, we use terminologies like pip. But when you're quoting indices, for example, like Dow Jones, NASDAQ, etc., we actually refer to the same thing as points. So I'll probably say like maybe Dow Jones has moved 10 points. I won't say pips. It could mean the same thing, but we refer to them as points. Okay. So hopefully that makes some sense. Now, I hope you guys are taking notes. If not, you can always watch a replay. This will always be there online forever. Now, that being said, so in summary, pip is the 5th digit of the decimal. Pipette is the 4th digit of the decimal, and pipette is the 5th digit after the decimal. Now, in some pairs, like the yen pairs, GBPJPY, AUDJPY, NZDJPY, and so on and so forth, the pip is the 2nd digit after the decimal, and the pipette is the 3rd digit after the decimal. So what that means is that in yen pairs, there are only 3 digits after the decimal. In yen pairs, only in yen pairs. Okay, there are 3 digits after the decimal. In the rest of the currency pairs, there are 4 digits. Some have 5 digits. Okay, hopefully that's clear. Now, so in the case where there are 3 digits after the decimal, it will mean that the 3rd digit is actually the pipette, and the 2nd digit will be the pip. So let me repeat that. In the yen pairs, because there are 3 digits after the decimal, unlike in the normal currency pairs where there are 4 digits and the last 4th digit is the pip, and where in the case there are 5 digits, the last digit is the pipette. In the yen pairs, the last digit, like without this in 1, 2, 3, this digit will be the pipette, the 3rd digit will be the pipette, and the 2nd digit will be the pip. So please note that down, write it down in your notes so that you don't forget. Now, in other pairs, metals and commodities, the pip is the 1st digit after the decimal. So that means in other pairs, metals and commodities, there are only 2 digits mostly. And even if there are 3, as long as it's a metal and a commodity, even if it's quoted as 3, just know that there's supposed to be 2 digits after. And so the 1st digit is the pip, and the 2nd digit is the pipette. Let me show you in terms of a real example. So let's look at a normal currency pair like Euro GBP. Okay. It has 1, 2, 3, 4, 5. So it's quoted as 0.86523. This is the base currency, and this is the quote currency. And what that means basically is that 1 euro, you'll exchange 1 euro and you'll get 0.86523 GBP. So that means in this case, the pound is stronger than the euro. Now, This is just, I'm just doing a recap based on what we spoke about earlier. Now, in terms of the pip and the pipette, the last digit is the pipette, the fourth digit is the pip. Make sense? Yes. And this is how it would look like on a chart. Now, this will go through TradingView in a different module, but this is basically how a Forex chart looks like. Don't mind the messiness and the lines and everything. I just want you to look at this area here, okay? We can see that Euro GBP is quoted at 0.86523. Now, this number here that looks like a square root, you know, is the fifth digit. We usually ignore this last digit, okay, because it's the pipette, and then this is the pip. So hopefully that makes sense. So for example, if we were to do a calculation, so we are looking at this, in this chart here, we can see their prices here. So let's say this price, let's say the price of Euro GBP was down here at 0.85 thousand, okay? This last digit 0 is the pipette. So you start counting the pips from the fourth digit. So if I was to say that the price of Euro GBP went up by 1 pip, okay, I'm going to add my 1 to this fourth digit, not the last. I'll ignore the last fifth digit and I'll add my 1 pip to below here. And so my final price, okay, if it went up by 1 pip, will be 0.85010. Does that make sense? Now, when the price goes up, it means that, remember what we talked about, we placed a buy order and the price was going up. So that's when, what I said, if the price goes up. So let's say we are buying. So if you're buying for 1 pip, okay, we are going to add the pip to the price that we're looking at, okay? And then, or the spot price, because this will be the spot price. If we are selling, I'll be subtracting. Hence, you can see buy is add, sell is minus. So I'll be subtracting the pip. So let's say the price began at 0.85 000, and the price went down by 1 pip. I will forget about the last digit first. I'll come here and minus 1 here. So my final answer will be 0.84990. Make sense? I hope so. Let's look at another example. Okay, trying to go to the next slide. Give it some time. Usually this happens sometimes when, wow. Just hold on, guys. Bear with. Technology sometimes does this. It decides it wants to flex a bit, show us who's boss. So this is where we are at. I'm going to go to the next slide. Sorry, guys. So let me go back. Hang in there, people. So we are back. Okay. So now I'm looking at example 2, which is Euro CHF, as you all can see. And Euro CHF just looks like Euro GBP. It has 5 digits after the decimal. So the 1, 2, 3, 4, 5. So 7 is the pipette, 5 is the pip. And we can see it here, okay? 7 is the pipette, 5 is the pip. So if this is the current spot price for Euro CHF, if the price goes up by, let's say, 10 pips, it'll be 1 goes up, meaning we are buying. So we are going to add the pips, this final price will be 1.09957. I've added 10 pips to 85, okay? And then I've brought back the 7, so it'll be 1.09957. If it went down by 10 pips, a final price would be, because I'm selling, 1.09757. Okay, guys, so hopefully you can see why it's important to know which is the pip and which is the pipette, so that when we're calculating the price change, we can do it the correct way. Okay, now we are now moving on to the next example 3. And example 3 is a yen pair, which is awesome. That's GBPJPY. Remember what I said? GBPJPY has 3 digits after the decimal. So what's the pip? The pip is the 4th digit. The pipette is the 4th digit. The pip is the 2nd digit. Okay, as we can see here. So let's say the price is at 150.324 and it goes up by 1 pip. So we are buying, we're going to add, the final price will be 150.334. If it goes down by 1 pip and we are selling, we are minusing the pip, so the final price will be 150.314. So the pipette, we don't use the pipette in our calculations. Okay, that's just basically the moral of this entire story. We ignore it, we only bring it back at the end once we've finished our calculation. Hopefully that makes sense. Okay, we have another example here, example 4, which is ZAUUSD. Now, if you don't know what this is, never seen this quote before, this is actually the quote for quotation for gold. Okay, so this is how gold is represented. Silver is usually ZAU. What is silver? Silver is ZAGUSD, and gold is ZAUUSD. Now, with gold, remember, there are only 2 numbers or digits after the decimal. Some brokers may actually have 3, okay? Whatever number they have, okay, you will ignore the 2nd digit. The 2nd digit is the pipette, and the 1st digit is the pip. Please note that in gold or metals. 2nd digit is the pipette. 1st digit after the decimal is the pip. So where do you place the pip? You start calculating from this 3 digit, okay? So for example, in this scenario, if gold at 1727.34 is to go up by 2 pips, we are adding, so we are buying, so we're gonna add the pips. The final price will be 1727.54. If we were selling gold from this price and price went down by 2 pips, the final price would be 1727.14. So in the scenario, let me give another example. If let's say gold was to go up by 10 pips, remember, this is the pip. So the final price was to go up by 10 pips would be 1727.34 plus 10 pips, which would be 1728.34. And if we were selling for 10 pips, the final answer would be 1727, or final price would be 1726.34. So again, please note the difference between metals and currencies and yen pairs, okay? Because there's a huge difference, and it's important to know that. Now that we're done with the pip topics, I want us to quickly look at something else very briefly, and this is lot sizes, lots. Now, the only way I can describe what a lot is, I want to use, so that I can make it very simple. The way we measure water, for example, we use liters. When we are measuring food stuff like grains, we use grams and kilograms, or weight, you know. So when it comes to calculating the units in currency, we use something called lots. Okay, so you'll always be talking about lots. So the biggest lot is the standard lot, which is 100,000 units of the base currency. The mini lot is 10,000 units, and the micro lot is 1,000 units. So think again about it like kg, gram, milligram kind of scenario. Okay, so standard lot is the big one, mini lot is the medium one, and then micro lot is the tiniest unit. So this is basically the three types of lot sizes. Okay, so we quote currencies in terms of lot sizes. Now, I also want to point out that I'm not saying that you're going to need $100,000 to trade. No, you don't have. You're not going to be trading with $100,000 when you start. You don't need to. If you have it, yes, but when you're starting out, you don't need to. Why? Because we have brokers. Okay, and I'll talk about that later on when you're talking about brokers. Now, here is for our for us to further understand lot sizes and calculation vis-a-vis the pips. So let's say, for example, we are trying to get the value of a pip. Now, every currency pair, because of how they are quoted, and they're all quoted differently in terms of value, every price change or that pip value or in change is different. So you find the pip value, let's say for metals and commodities, is different from the pip value for currency. Okay, and if you know that, then you know that at the end of the day, even when you're trading, it's like the same way, like maybe somebody is buying a kg of sugar and somebody else is buying a kg of meat. Just because we're using kg doesn't mean that the kg of meat and the kg of sugar are the same price. Same thinking or same mindset. So the lot sizes for when you're the pip value for, like when you're calculating price movement in gold, for example, or indices, or and vis-a-vis currencies is different. You find that commodities and metals the pip value is higher than that of currencies, and even within the currencies, you find that the pip value also ranges. Okay. Now, so let's say, for example, so a contract value like is usually for one lot. For one lot is 100,000 units of currency, right? Standard lot. It's a standard lot. So in this example here, we have the USD quoted against the Japanese yen. So we like to call it USD/JPY. In short, you hear people saying UJ. So UJ has been quoted as 109.293. That basically means that $1 is equal to 109.293 yen. Okay, so in this, or $100 will give you 109.293 yen. Okay, so in this scenario, we are talking about the contract value, 100,000 units or USD. You multiply it by 109.293, the quote given for this price at this particular point in time, and you'll get the value as 109.293 yen. So what that means is, for you to get 100,000 units of USD, you need 109.293 units of yen. Okay, when you're purchasing a standard lot. Okay, so a standard lot is 100,000, but because the values of the currencies are different and they're quoted differently, as you can see, then you multiply that by 100,000 to get how much yen is used to move the same amount of USD. Okay, so hopefully that you understand what I mean when we talk about contract value. Now, then we have the pips value, which is the profit or loss for pip movement. Okay, profit or loss. Okay, so if price goes up to 109.303, then the contract value is 109.303 yen. Okay, the pip value is the difference in the price change, which is 10 yen. Okay, so when you're trying to calculate the individual pip value, you're going to take the base currency, which is 10, divide by the price of the quote, and you'll get the final price here. So it'll be 10 yen divided by 109.293. Okay, so you're taking the pip value and you're dividing it by the value of the base currency. This is the quote and the base currency. So that's 0.09149. So this now becomes the pip value. Okay, so 1 USD in essence, essentially, like if it move 1 pip of this currency will earn you $0.09149. Okay, hopefully that makes sense. If not, just watch this again, and even you'll be able to see it. You don't have to know this calculation, but the reason why I'm explaining this is because when you actually go on your MT4 later on your trading platform, you will see that when you're trading, even if you trade a standard lot, depending on what currency you're trading, some will earn you more money than others. So when you understand that, when you understand this, you'll understand why. Okay, because they're quoted differently. Okay, and that's why you get different pricing. So the pip value is always in the quote currency. Okay, and which is the yen in this case, base and quote currency. Okay, and the value of the pips is based on how many lots are taken. So a standard lot, if this was a mini lot, remember a mini lot is 10K and a micro lot is 1,000. So the calculation would be different. You would then multiply 10K by 109.293, which would be 10,929.3 yen. Okay, so the price would be different. And the same with if it was 1,000 a mini lot, okay, or a micro lot. Sorry, yeah, micro lot. Anywho, so in summary, every pip movement is equal to dollars. It doesn't matter what you're trading, whether you're trading Euro USD, you're trading Euro JPY. Every single pip movement is going to earn you some money, but the value will be dependent on the pip value for the currency that you're going to be trading, the quote currency that you're going to be trading, or rather the base currency that you're going to be trading. So there's another definition here that I want to make before we call it a day on this training, and this is on leverage. Now, if you understand leverage, you'll understand that, you know, in the Forex market, you need leverage to trade. What this leverage is really is basically funds that are loaned to you by your broker. Okay, and this is where I'm going to bring in the broker aspect, whereby you need a broker to trade. Okay, because the broker provides you with a trading platform, but they also provide you with the liquidity through their liquidity partners. Okay, and their liquidity partners are usually big banks and so on and so forth, who then give access, the brokers access to the liquidity that then we are able to also access through the broker to trade the foreign exchange market. This is what enables you with, let's say, any trader with any amount to trade, because you don't need $100,000 to trade. You can trade with even $10, depending on your preference. You can trade with $50, you can trade with $100, and you can still play around with the different lot sizes, okay, or the different contract values, just as if you would, like, you can trade a standard lot with $100, whereas before, or if you look at it in the stock market, for example, in the stock market, you would need $100,000 to buy 100,000 units of stock or shares or whatever. But in the Forex market, you just borrow funds from the broker, meaning the broker gives you leverage. That borrowing is leverage automatically. It's not like you're going to ask the broker for loans, a loan every time, but when you open your account, you will choose the leverage that you want, okay, to get. So brokers can loan you up to 1,000 of your money. This happens only in Forex, okay? So with other assets like commodities and metals, it's a bit riskier, so they may not loan you up to 1,000. They may reduce the leverage because of just how volatile those markets are. But in Forex, up to 1,000. What does that mean? That means that for every $1 that you're going to trade in the market, you're going to invest in your account, the broker will match it 1,000 times. So if you put $100 in broker account, the broker will give you a leverage of 1,000, which is 100 times 1,000, which is 100,000, which will enable you to trade as if you actually had $100,000 to trade. Does that make sense? I hope so. So that is what leverage does, and that's why we are happily able to trade leverage. So let me give you, this table should give you a summary of how that looks in real life. So we have different types of leverage. Usually the stock market will be like here, 1:1. Like you literally need to trade 100 to, like you need to have the margin to trade. So if you don't have the money to trade in the stock market, there's no one who's going to lend you that money. You have to put it up front 100%. Okay, so you're going to be having exposure to your account 100%, for example. Then we have leverage of 2:1, whereby your exposure is 50%. So you can put down 50% and your amount will be matched twice. So you'll be able to manage $100,000. Then there's 10%, 10:1. So you have 10K, but you can manage 100K, and so on and so forth. And hence, this is what I was telling you about 1:1,000. You can trade with $100, okay, and still have access to 100,000 in terms of cash. Now, the thing about leverage, though, it's a double-edged sword. I like to say that because if you don't know how to use it, it can end up working against you. So I know this looks so exciting, but usually I advise traders, don't try and go for 1:1,000 leverage. You know, cap it at, let's say, 200, 400. Anything above that, I think is really risky, because I mean, the more money you have, also the more money you can lose. And if you think it's a false sense of security sometimes, you know, when you're trading with too high leverage, especially if you're new to trading and you're still navigating the space and trying to figure things out. Yeah, so that's basically that. Yeah, so I usually cap it at, 200, 400. I personally prefer 1:50 or 1:100. I don't like to go above this. I used to like brokers would give me like 500, European brokers would do that, sometimes Cyprus brokers and stuff like that. But nowadays, I actually appreciate low leverage, because then you learn to trade with discipline and you don't get greedy, because sometimes, like I said, false sense of money in your account. That's what leverage does. So yeah, so in summary, be careful with leverage. Like I said, if you choose large leverage, you can also lose large. So it's not, remember, this is a real market. You're going to be taking losses at some point. So if you're not careful, then your losses will be as huge as your leverage. Okay, so there's something else called short selling. And basically, yeah, so this, you remember how I actually mentioned that, when you're placing a buy order or a sell order, for most traders, especially in the beginning, they understand buy orders, but they don't understand sell orders. So they're like, okay, so what am I selling? Because if I'm just starting out, I don't have the currency pair. So what am I selling? So within the industry, we are able to do what is called short selling. And this is where you sell an asset that you don't own, okay? You effectively sell by borrowing the asset. So let me give you an example, okay? Let's say, for example, you have a phone, or not you, your friend has a phone, and your friend has an iPhone 11. And right now we have the iPhone 13 that has come out, or is it the 14? And so possibly it's what, $100 possibly, I suppose. So we have your friend has an iPhone 11, which is currently valued at $900. Okay. Now, what if you went and borrowed that iPhone from your friend? And you just borrowed it. You're like, okay, can I borrow your phone for the night or the weekend? I'll bring it back in 2 days. Then you go and post it online on eBay. Okay. And then the reason being is you want to sell this phone. Yeah. And you get a buyer to buy it at 900, but you're not just selling this phone for the sake of selling it. Okay. You have a plan. Okay. You know that there's a new phone, iPhone 13 or 12 or whatever, which is coming out, and it's going to be higher. Okay. So when you're trying to sell this phone, okay, So yes, the new iPhone is about $1,400. Let's say $1,500, whichever. You find that the price may drop because this new phone has come out now. So you know how iPhone plans their launches, and you know as soon as the new iPhone comes out, automatically this iPhone 11 will go down in value. Okay, so the price drops to $600. Okay, and when it drops to $600, you sell the iPhone at to a buyer who's willing to pay $900. You pocket the $300 and you take back the phone to your friend. Was the phone yours? No, but you made a profit of $300. Does that make sense? So it's the same thing that happens in the Forex market. You borrow current assets, whichever you're trading, from people in the market who are selling. Now, this market always has buyers and sellers, always has buyers and sellers. There's no way the market can operate without buyers and sellers. It always has, and that's why we say it's the most liquid market in the world. You'll always find somebody who's looking to buy the Euro USD at the price that you want to buy it, or wants to sell the Euro USD at the price you want to sell it. So now that we understand short selling, you don't have to worry about what am I selling. Just know that there are people on the other end who, when you're buying, they're actually selling to you the currency at the price that you want to buy. And when you're selling, there's somebody on the other end, okay, electronically, digitally, buying or wanting to buy at the price that you're selling. Whether you see them or not, this is how the marketplace operates. So this chart here just shows you practically, like when we are buying, okay, for example, let's say, for example, there were sellers up here and they anticipated that the price would go down, so they began to sell. They're selling to willing at every level here. They are buyers at different prices, okay? So the price keeps on going down as they're selling. And then at this point here, there are also buyers who are who are just waiting for price to come down here to buy, okay? And so on and so forth. And it keeps on happening and repeating itself. So what you find that when someone is selling a currency pair, they're basically anticipating that there'll be a price move down. And what is happening is that they're short selling that currency, they're shorting the market. When they're buying the market, they're basically anticipating that the price will go up, and hence they are long, they're posting longs in the market. Okay, they want to long the market or buy the market. Now we also know that sellers are also what we call bears in the market. So the sellers are the bears. Sometimes you hear the market is bearish. It just means that there are very many people selling the market. And the market could be the Euro USD market, it could be the indices market, it could be whatever market. So you find that maybe the Euro USD is bearish, the GBP yen is bullish, and so on and so forth. Bullish being the buyers. There are people who are buying the market. Okay. So the market is always shifting from buyers to sellers to buyers and sellers. What we do as Forex traders is try and figure out, okay, where to buy, when to sell, and so on and so forth. That is what we are consistently doing every time we are going into the market. We are trying to establish, should I buy or should I sell or should I short the market? Should I take longs or put long positions, or should I put short positions or short sell the market? Okay, so hopefully again this makes sense. You buy before price goes up because you want to buy low, and you sell when the price is still high before the price goes down. You never want to sell the price or currency when the price is low. You're going to be losing, because if you're selling too low, that means buyers are already coming into the market. So you'll find yourself in a negative position. Okay, so you sell high, you buy low. Sell high, buy low, and vice versa. So that's the end of that. I wanted to also mention one last thing. I think I'll mention in module 3. So in module 3, we'll talk about brokers. Okay, guys? So this is where we're going to end for today. I hope this has been beneficial. Thank you so much for just watching up till now. If you have any questions with regards to, you know, buying and selling and things like that, please, by all means, or what we've discussed today, all the terminologies and definitions, if you want me to do an extra, recording on a specific topic we've discussed today, please let me know. Simply comment in the comment box. Thank you guys, and see you soon in the next module. See you soon. Bye.